Hi everyone, welcome back to my channel. In this video, I will be discussing 0DTE and how I effectively trade Tesla and QQQ contracts. So to start, let's define what 0DTE is. 0DTE trading refers to executing trades and options that expire on the same day that they are open. So these contracts have 0 days to expiration. This approach is favored by traders seeking quick profits or looking to capitalize on short-term market movements because the performance of the stock is focused on minute-by-minute changes as opposed to weekly, monthly, or yearly movements. With that being said, I want to provide an example to show the elements of a 0DTE contract. One major factor of 0DTE options are that since they are short-term, these option contracts are less expensive and therefore more affordable to trade, which means the average trader can buy more contracts at one time than that of a longer-term DTE. So on the screen, you see that I have Apple. Apple, of course, is traded on the NASDAQ. At the time of filming this video, the stock price is $168. Now I have 3 reference points of a call at 170, as it's always necessary to choose a strike price in the money. At 0DTE, the cost would be 0.64, which equates to $64 for one contract, which is pretty inexpensive. Now for the same call price at 16 days to expiration, the cost is $380 per contract. And lastly, if you were to look at the days to expiration at the 93-day mark, again, with the same call price set to 170, the total cost would be $850 for one contract. Thus, you're paying over 10 times less on a 0DTE contract than one that is 90 days out. So given this example, it's very clear that 0DTE options are substantially more affordable. And with 0 days to expiration, keep in mind that time decay, aka theta decay, plays a significant role in the value of your options contract. So when you make these trades, monitor them closely and be prepared to exit if the market moves against you or if your profit target is reached. Since time decay accelerates as expiration approaches, the value of your options can decline rapidly if the market doesn't move in your favor. So now that we have a basic understanding, let's look at some of the advantages of 0DTE contracts. One major advantage in 0DTE options is that they generally have higher volatility. Therefore, the stock incrementally moves faster. This often means that 0DTE stocks have more motion in price changes than long-term options because of the volume. So what does that mean? The faster the stock is moving, the more opportunity there is to make larger sums of money. For example, index ETFs like QQQ or SPY, which are really popular, are traded more frequently on 0DTE options, which allows for smaller bid and ask differences, resulting in the ability to purchase more quantities of contracts. Essentially, the major takeaway is that higher volume equals higher liquidity. So now let's look at some specific option contracts for the upcoming week involving Tesla and QQQ. The very first thing I do when developing a new watch list for the week ahead is to evaluate and conduct market analysis. I begin by analyzing the market and identifying potential trading opportunities. For me, this can involve fundamental analysis such as watching the news, reviewing earnings reports, studying economic indicators, and technical analysis. This just entails viewing chart patterns and indicators, and I already made a video discussing my top 5. Then I take a look at the perceived motion. I then determine whether I can expect the market or a particular stock to move up, down, or remain relatively stable over the course of the day and week. For any beginning traders, it's important to focus on strategic trade management. This just helps to maximize profits. So when scalping, it's a good idea to look for momentum trading opportunities. Then decide on your entry point for the trade. This could be based on technical levels, such as support and resistance, or it could be a specific indicator that you find favorable, or even a price level you anticipate the stock to reach. Once you've identified a potential opportunity, select the appropriate options contract. These are often referred to as weeklies, which you guys can see here on the screen. Choose the strike price, of course making sure you stay within the money, and then of course you want to take a look at whether you're going to be placing a call, which you'll see on the left side, and puts here on the right. Based on that, use your trading strategy and of course your evaluation of your analysis to make the appropriate trade you feel is necessary. So of course you guys see I have Tesla pulled up, and then of course the option chain is going to be for the week of April 26th, which is this upcoming Friday. And I just want to break this down so that everyone has understanding for those who don't know. When you see this number right here, this number 6, that's going to be how many days of DTE for these particular contracts or this set of contracts. So obviously within 6 days, these contracts here will expire. You see right here, if you were to click on May 3rd, it'd be 13 days for these contracts, and then so on and so forth. So this number in parentheses tells you the DTE, which is that, of course, days to expiration. Within that, I also want to focus on the fact that Tesla's stock price is 147. So again, as I mentioned, you want to stay within the money, which is the strike price. Now, I have 10 strike prices pulled up. Some people like to use, you can try 12. If 14 works better for you, you can use 14. And even if you want to see all of the strike prices, they list them all, and there are a ton of different options, as you guys can see. But me in particular, I like to focus on 10, okay? So again, we know calls are always on the left, puts are going to be on the right. So let's say I wanted to make a play for Tesla to go up maybe $1. So I would say, okay, I'll put in a call for that 148. Now, the price of this contract is going to run me $660. So it's important to note that one contract would be that price. Now, if I wanted to put in a play for puts, and let's say I thought the stock was going to drop down to 146, the contract would cost me $640. So keep these things in mind when you're considering your trades, okay? I'm going to show you guys QQQ, same thing here. And then I kind of already pulled up a few different options. So we see QQQ, this one, the date of expiration is going to be in 2 days, which would be the DTE for Monday if you were going to go ahead and trade this stock. And then I looked at a few other options for 3 days and then 6 days out. So let's just focus on the 0 DTE that we would have if this was Monday. You would see that would be at the 0 mark, of course, would be for that day. Now we see the price of QQQ is $414 here. So if we were to go ahead and put in a play for calls, we would go ahead and look at that maybe $415, and that contract would cost us about $214. Now, of course, if we were look on the opposite side for puts, let's say we thought the contracts would go down or the stock price would go down to $413, we'd look to pay about $160 for these contracts. Now, again, in order to make sure that I'm making these high probability trades, I always focus on the charts. I kind of went over this in the last video, just understanding technical analysis. You guys will see patterns and different things that will indicate whether or not you should enter for calls or puts on either direction. It's important to just know your strategy before you hop into these trades. But going back, I want to just pinpoint this, okay? It's important to note that even though you have all these strike prices and you can choose whatever variation you would like to, focus again on the delta, theta, and the gamma to know exactly how much you'll pretty much make off of each contract that you put in terms of how profitable you'll be. Now, I'll go over the Greeks in another video. That way this video isn't extremely long, but it's important to note that those are going to be the helpful levels to let you know whether or not you're going to make a certain amount of money on each dollar or each particular contract that you put in for, okay? So that is pretty much what you would need to know as far as how I place trades, as far as what I do in order to strategically know whether or not I'm going to hop into a trade for calls and puts, and how to know which contracts to choose from. So that's going to be the most important factors for this particular video. And of course, it's helpful to mention that you should keep in mind you aren't forced to wait until the market closes to end your 0 DTE option contracts. You have the opportunity to leave your position and take profit if you're at your target, or if you have a stop loss, you can cut your ties at that point. So just be mindful that you can enter or exit a trade at any time. You aren't restricted to keep your position until the end of the day just because that's when the contract will expire. As a matter of fact, I always recommend to new traders, if the market moves in your favor, consider taking profits by closing out your positions. And of course, that will help you mitigate any risks that you would have as far as losing money, and it'll also help you keep the money that you have gained. And if you have any positions that you're still holding, scaling out progressively throughout the time period you feel comfortable with is fine too. All in all, 0 DTE trading can be challenging and requires continuous learning and adaptation, but the advantages are increased on high probability setups because of the short-term price movements. So keep track of your trades, analyze your successes and your failures, and refine your trading strategy over time. If you have any questions, feel free to leave them in the comment section below. And I really thank you guys so much for watching, and I'll see you in my next video.